catch up. And the reason I bring that up is your quiz, first quiz, is 1 week after, no, don't worry, it's not 1 week from today, but it's 1 week after, it's actually 2 weeks from today, right? Exactly 2 weeks from today. Which means if you haven't looked at the stuff, you haven't looked at past exams or quizzes, this is a great weekend to catch up. I mean, it's President's Day, what are you going to be doing? Now, it's not exactly a religious holiday or a family holiday, so this is exactly the time to catch up. Okay? But I think one of the best ways to kind of caught up is to get your project going, because working through the numbers I think is a great way to kind of get the mechanics done. Okay? So let's kind of close the books on the cost of equity. 3 inputs, right? Risk-free rate, risk parameters, risk premiums. Let's summarize basically what we concluded. The risk-free rate, the key is to make sure that you stay consistent. Once you've made a choice of currency, dollars, euros, rupees, your risk-free rate has to be in that currency and it has to be risk-free. And so clean up for default risk. Second, risk premium. We looked at 2 ways of estimating, right? The historical premium number, which came from looking at 1928 through 2005 or 2008 with all its messy after effects, which right now works out like 3.88, 3.9%, or an implied premium, which is about 6.5%. I think at this point in time you'd be crazy to go with the historical premium in your valuation, because the results are going to be predictable if you do that. Your valuations are going to kind of inflate out, everything's going to look cheap. And finally, betas. We talked about regression betas and all the problems associated with them, and I gave you my sales pitch for bottom-up betas. Now, of course, we also talked about lambdas. And for those of you who are working with companies with significant emerging market risk exposure, I think it's worth the effort of bringing lambdas into the process. If nothing else, it forces you to think about where this company does business and where it's growing and the risks associated with that growth. But don't get too caught up in the mechanics of lambda. If you have 35 countries, don't try to do 35 lambdas. It's going to destroy your time, your time budgeting. You won't have time to do anything else. So bring in country risk, but bring it in some consolidated way. Maybe 3 lambdas, maybe 4 if need be, but not 35 lambdas. Any questions on the cost of equity? Today then I want to move on to the cost of debt. Let me again start off by specifying what I'd like the cost of debt to measure, and then we'll talk about ways of doing it. The cost of debt is the rate at which a company can borrow money long term today. 2 key words there, long term and today. First, I don't care if you have a lot of short-term debt. I'm still going to attach a long-term cost of debt to it, because in a sense my cost of capital is a long-term number. My cost of equity is based on a 10-year risk-free rate. It's inconsistent for me to use commercial paper rates as cost of debt, even if that's the only way you borrow. So I'm in a sense going to take all your debt, short-term as well as long-term, load it all up and give it one cost of debt. It's going to be a long-term cost. And it's got to be the rate at which you can borrow money today, as opposed to what? You can look at the books and see what debt they took on 2 years ago, 5 years ago, what the coupon rate on the bonds is. It's a waste of time and resources. Don't waste your time looking at past debt issues, loading them up, taking weighted averages, because it's not going to give you a current cost of debt, especially after what we saw has happened to default spreads and equity risk premiums over the last year. Looking at the rate at which a company used to borrow is not even useful in this exercise. So what you want is a rate at which you can borrow money today. So you want long term today. So how do I go about estimating? Let's take the easiest scenario, right? What's the easiest scenario to estimate cost of debt? You want a current long term cost of debt. What kinds of companies should that be easiest to do on? I'm sorry? One is, if you have just bank loans, your life is difficult, right? Because they don't update the loans. But if you have bonds outstanding and the bond is traded, and there's a price for the bond, you can compute the yield to maturity and you're home free. Unfortunately, though, yields to maturity in bonds are kind of dicey measures of cost of debt. And here's what. Can a risky company issue a safe bond? Is it possible for a risky company to issue a safe bond? How would it do it? What it will do is it will take its safest asset, secure the bond with it. It is conceivable that you could be a risky company and issue a safe bond. You see the danger now? If I take that safe bond, I look up the yield to maturity in that bond and make it the cost of debt for the whole company, I'm attaching to the rest of the debt a cost that is not feasible. It's going to be too low. I'm always wary about using yields to maturity on a bond. So if you came to me with an AT&T bond and say, yeah, the yield to maturity is 7%, can I use it as my cost of debt? My first inclination is I don't trust it. But the nice thing about issuing bonds, though, is if you usually, I mean, it's not required, but almost every company that issues bonds does this, you get a bond rating, right? The advantage of a rating, and we've used it before with countries, is you tell me your bond rating, AAA, AA, triple B, double B, I should be able to take that rating and come up with a default spread for the company. So if you're a rated company, again, somebody else looks like they've done their dirty work for you, and you essentially use the rating to come up with the cost of debt. What are the catches of using a bond rating to come up with the cost of debt? Can one company have more than one rating? Each bond is rated. Companies actually are not rated. You can actually have 3 bond issues with 3 ratings. In which case, you can end up with a different cost of debt depending on which rating you latched onto. Okay? So even if you have a rating, check it out. Make sure that that is a rating you can live with in your cost of debt. And how can you check it out? Be a ratings agency. Give the company a rating. I mean, call it a synthetic rating, but that's just a fancy way of saying, hey, you're estimating the rating for this company based on its financial ratios, on its financial standing. Hey, for those of you in my corporate finance class, you're probably familiar with the approach I use. I actually use one ratio. The ratio I use is the interest coverage ratio. Operating income divided by interest expense. I take that ratio, I go to a table, a lookup table. You tell me what your interest coverage ratio is, I'll guess your bond rating. Okay? Let's take an example because it's kind of, I'm clicking and nothing is happening. There's a reason for that. No? So let's take an actual company. Let's take Embraer, right? Brazilian company. And many emerging market companies, many European companies, even most US companies don't have a rating. So you don't even have the choice of looking up a rating, you have to estimate a synthetic rating. I looked up 2 numbers for Embraer. I looked up the operating income and I looked up the interest expense. But the operating income I noticed kind of moves around. There were good years, there were bad years. So to kind of get rid of that variability, I'll use the average operating income from 2001 to 2003 in my numerator. Remember, the interest coverage ratio, you control the computation. You're not fixed with using last year's numbers. You can say, I don't trust that number. And take advantage of that this year. You know why, right? Because what's the operating income for many of your companies going to look like once the 2008 numbers come out? It's going to look awful. You plug that number in, every one of your companies might be a D-rated company before you know it. So here's one way to get around the problem. Rather than focus on last year's operating income, look at an average across time. The average operating income between 2001 and 2003 was $462 million. The interest expense for the most recent year, and here I don't average. Because here I'm not worried about jumping around. If you borrowed a lot of money last year, you have a lot of interest expense, I want to reflect it. So the numerator I averaged out, the denominator I left at the actual interest expense, because that's what you have to pay. The interest coverage ratio I came up with for Embraer is 3.56. Is that a good interest coverage ratio? Who knows? Until you compare it to the rest of the companies out there, you can't pass judgment. So I'm going to show you the lookup table that I've used historically to come up with the interest coverage ratio, the rating. This is the table that converts your interest coverage ratio into synthetic rating. There are 2 sets of numbers. The first set of numbers is for companies with market cap greater than 5 billion. The second set of numbers are for companies with a market cap less than 5 billion, large companies and small companies. You see a pattern there. For large companies, you need a lower interest coverage ratio to get to a higher rating. For smaller companies, the standard is higher. So to get to, for instance, a AA rating, larger companies can get there with a 6.5 to 8.5 interest coverage ratio. Smaller companies need 9.5 to 12.5. So there's my table. For Embraer, what was the interest coverage ratio? 3.56. Its market cap, and I should have given you this, is in fact well above 5 billion or was well above 5 billion in 2003. This is a large company. 3.56 interest coverage ratio. So looking at the first set of numbers gives me an A- rating. But remember, the rating is not the end game here. The rating is useful only because it gives me a default spread. So in 2003 and 2004, those are the default spreads. And you can already see that the numbers, in fact, were much higher in 2003 and 2004. In fact, in 2004, when I looked at Embraer, the A- rating translated into a default spread of 1%. So at the time that I looked at Embraer in 2004, I took their interest coverage ratio, came up with the rating, took the rating, come up with a default spread of 1%. What do I add the 1% to? whatever my risk-free rate is. So once I've made my choice of currency, the risk-free rate is already there. I add the 1% to it to come up with my pre-tax cost of debt. Okay. There's one loose end with Embraer that I have to deal with here. It's a default spread plus risk-free rate. So if I were doing my analysis in US dollars, for instance, which is what I was using for Embraer, the risk-free rate was 4.29%. I add 1% to it, I come up with 5.29% as my cost of debt for Embraer. What am I missing when I do that? That it's a Brazilian company. Why does that matter? Well, Brazil has default risk, and for better or worse, Brazilian companies carry some or a big chunk of that default risk. It's not fair. As an emerging market company, you carry two burdens of risk on your shoulder: your own risk, company risk, and country risk. So here's my final computation. I took the 1%, which is my default spread based on the rating. I looked up the default spread for Brazil as a country, which was 6%. You're saying, why not add the entire 6%? Embraer does get a lot of its cash flows in dollars. It was actually, I mean, if you look at companies like Embraer, like Aracruz, that get cash flows in dollars as opposed to reais, they actually don't seem to bear the entire burden of default risk. If you look at the bonds issued by them relative to the bonds issued by the country. So I made a judgment call. I took only 2/3 of Brazil's country risk. If you feel queasy about being this subjective, what's the other measure you could use to kind of scale? What did we do when we did cost of equity? What do we use? We used lambda, right? So if you feel that lambda is a good approach to estimating, you could actually use the lambda here to come up with the cost of debt for Embraer as the risk-free rate in US dollars plus 4%, which is 2/3 of the Brazilian country risk, country default spread, plus 1%, which is the company default spread, which gives me a US dollar cost of debt for Embraer of 9.29%. So let's review. If you have a developed market company where you don't have to worry about country risk, you take the risk-free rate, you add the default spread, you're done. If you have an emerging market company where country risk is kind of overhanging the company, you take the risk-free rate plus default spread for the company plus default spread for the country, which will give you a much higher cost of debt for an Argentine company than for a US company of equivalent interest coverage ratio, simply because that country risk factor is going to push up your cost of debt. Okay. Any questions on this process? Yes?
Are there tables for historic bond ratings, like if you wanted to look at,
Do I save these tables over time? I probably have them on my computer, because the one that's online that I put is actually the most recent one. But if you want, you're looking 2000, 2003, something like that?
Yeah, earlier.
Okay. Earlier I might not have, but it depends upon how early. Okay, if you're saying 1955, forget about me. So, but I do have it going back, I think, to 1996 at least. So, yes.
In the case of Embraer, they have a lot of loans from developing banks, such as the Brazilian Development Bank.
At subsidized rates. They do get subsidized rates. Can I hold off on that question, because I'm going to come back and deal with that. Did everybody get this question? Embraer actually gets loans at subsidized rates from the Brazilian government and related entities at rates well below 9.29%. So one of the questions I'm going to come back and ask you is, when I do the cost of capital for Embraer, should I build in that subsidy into the cost of capital? For the moment, I'm going to act like there's no subsidy, but we'll come back and address that, because that is an important question. Right? Any other questions on? Yes?
So the interest coverage ratio is backward-looking historically.
Sure. So make it forward-looking. So if you want to use expected operating income for next year, expected interest expense, I won't stop you. Right? I mean, in a sense, I am completely agnostic about how you come up with operating income and how you come up with interest expense. I went back 3 years here, but if you said, look, I don't trust the history, I'm going to use my expected operating income for the next 3 years, go ahead. The table still works, right? In a sense, give yourself the flexibility. And this year especially, I think you might need all the flexibility you can find to get to an answer. Okay? So look backwards, look forwards, make your best estimate. So, but there's no rigidity in the computation. I'm not saying use last year's numbers, use the average for the last 3 years. So feel free to replace those with numbers that you think are more reasonable. That's basically what we're trying to estimate, right? But that kind of it kind of redefines the problem. It doesn't give me a solution, right? Because when I say the rate at which you can borrow money long term today, that's exactly the question I'm asking. The question is, how do I come up with that number, given that companies are not obliging by issuing debt constantly? Okay? They have debt on their books from 2 years ago, but they're not exactly borrowing money today. That's exactly the question we're trying to address by coming up with the rating. But the rating to us is a means to an end. What we care about is the default spread, because that's effectively what's giving us the cost of debt. Okay? Yes?
The spreads overall have changed drastically in the past period.
We'll come back to that. There's a whole slide that we'll cover on this side.
Have those numbers for
The ratios for the ratings? That's actually, there are two parts to this table, right? One is coming up with the rating given the ratios, and the other part is taking those ratings and coming up with the default spread. The part of the table that's very volatile is the default spread part. The ratings part is actually very, very stable over time, because ratings agencies, I mean, it's not like you get up one day and say, I'm going to redefine the way I think about credit risk. Okay? So from that perspective, they don't change. One question I do get asked is, why don't I use multiple ratios? Because this seems to be putting all your faith in one ratio, interest coverage ratio. Why not have 7 ratios or 9? Two responses I have to that. One is, the minute you bring in 7 or 9 ratios, you have a follow-up decision to make, right? What do you have to do? You have to come up with some weights to put on those ratios. I mean, you've seen Altman Z-scores, the weights. So I'm not saying you can't, but you can come up with a weighted ratio. But then it becomes a black box, right? You go to a company and say, you make up your own W score or K score or L score is this. They say, what's an L score? Well, it's 0.33 times this ratio plus 0.15 times this. Where do those come from? You're going to spend the whole day talking about how you came up with that score rather than discussing cost of debt and cost of capital. So that's my first response. The second is, if you look at those ratios that go into those credit scores, they tend to be highly correlated. In other words, you take one ratio, when one moves up, the other's EBITDA to fixed charges and interest coverage ratio have a correlation of about 0.94. When one goes up, the other goes up. When one goes down, the other goes down. When you put in these multiple ratios, which are highly correlated, I'm not sure you're gaining that much. And here's my final response. I'm not a fixed income guy. See why that matters? I don't care if I'm off by 2 notches on the rating. If I gave you an A rating instead of a double A rating, it's not going to end my world. But if you're a fixed income guy, you want precision. I don't care about precision here. All I want is a rough cost of debt. So I'm willing to take a more simplistic approach that might not give me as precise an answer, because the trade-off to me is it's more transparent. People can see where the cost of debt is coming from. They can agree with it or disagree with it, but there are no black boxes here. Okay? Yes?
What if, when you calculate, let's suppose you got the 9.3%, what if your short-term credit line is at a lower rate than that?
I don't care. That's always going to be the case. So did everybody get his point? Because I'm computing a long-term cost of debt. Given that the term structure is upward sloping most of the time, when companies use short-term debt, they will actually borrow at a rate lower than this number, right? In fact, I've had CFOs jump on me saying, hey, but we can borrow money at 5% short-term. I say, fine. But you got to roll over that money, right? What I'm interested in is what the long-term cost of your short-term debt is. And I can't give you a lower cost of capital just because you chose to use short-term debt. You see why? The minute I open the door and say, I will attach a cost to your debt based on whether you borrow short-term or long-term, what are companies going to do to lower their cost of capital? They're going to try to retire all their long-term debt, replace with commercial. Look, it's cheaper now. I use commercial paper. I want to look at the long-term cost of borrowing, even if it means borrowing short-term and rolling it over. You want to play games with the term structure, don't do it on my watch. Right? Because in a sense, companies do this all the time. I can play the term structure. Why are you doing this? You're a paper and pulp company. What the heck do you have to do with the term structure? But when costs of capital are computed based on actual interest expenses, this is exactly what you create as a problem. Because you can make it look like it's cheaper by borrowing short-term as opposed to long-term. I'm saying, no, that's fine for you to play a game on this side. If you make money on the game, great. But I'm not going to give you a benefit in your valuation just because you use short-term debt as opposed to long-term debt. So the way to think about this is think of this as the rolled over cost of short-term debt. In other words, you take commercial paper and you keep rolling it over. I'm saying over the next 10 years, this is what your rolled over cost is. I'm essentially assuming that the long-term cost of debt is effectively just the cumulated short-term cost over that period. Okay. Any other questions? Yeah. Now, I use this table all over the world. I mean, I use it in India, I use it in Brazil, I use it in, I mean, because in a sense, especially when you go outside the US, you don't even have a crutch of a rating. You actually have to do synthetic ratings for almost every company analyzed. And I mean, one of the issues is, I mean, this table was developed by, how did I get this table, you think? You know, that lookup table, how did I basically looked at rated companies and built the table up from actual ratings and what their interest coverage ratios were. But the problem is most rated companies are in the US. So this table is almost a US-centric table, right? I mean, I can't do a table like this for Asia. There aren't enough rated companies in Asia for me to do this table. So I'm taking a table that I developed looking at US companies, and I'm moving all over the world saying I'll get the rating for a Brazilian company, an Indian company, a German company using this table. And there's a danger there. I'll tell you when I feel comfortable using the table and when I get a little queasy. In markets with interest rates similar to the US, I feel perfectly comfortable using the table. So when I use this table in Europe, I am as comfortable with the European company synthetic rating as I am with the US company synthetic rating. However, when I use this table in a market where interest rates are much higher, I think I'm going to underrate companies. Do you see why I'm going to underrate companies? Let's say interest rates are 15%. What do I need to get an A rating here? 6.5 to 8.5 interest coverage ratio. You know how difficult it is to have a 6.5 interest coverage ratio of interest rates of 15, 20, 25%. Okay? So in emerging markets, the table probably will start breaking down, especially if rates start to climb. If you want to adapt the table, you can do that. Basically, you'll have to go through the interest coverage ratios, kind of scale them down as interest rates go up to reflect the fact that as interest rates go up, it becomes more and more difficult to deliver 9 times interest expenses, 12 times, or 15 times interest expenses. So for the most part, I'm comfortable using the table because the alternative to me is to use a bank interest rate or a book interest rate, which often has no relationship to the actual cost of debt. Okay? So interest coverage ratio, synthetic rating, default spread. Stick with a long-term cost of debt and attach it to all of your debt. Now, Aparjit mentioned default spreads changing. Just as equity risk premiums kind of exploded out in 2008. I mean, default spreads reflected the same phenomenon. In fact, to show you how much default spreads have changed, I've actually taken ratings from AAA down to CCC+. Every ratings class. You look at the default spread at the start of 2008 and the start of 2009, roughly speaking, default spreads across the board have doubled. You know what this means, right? So if you look at a company, it's the same rating today as it did a year ago. Its default spread now will be twice what it was a year ago. Luckily for the company, the risk-free rate has decreased, so maybe their overall cost of debt might not have changed, but the breakdown of how much of that is risk-free and how much is default has changed. Okay. Here's the reason when you looked at the equity risk premium table, you have to bring this in as a companion. Both debt and equity have become more expensive to companies. That's why raising financing now in this market is such a pain in the neck. Because it's not as if one has gone up and the other stayed stagnant. They both have increased, and you see that reflected in default spreads. So the default spreads you will see built into the spreadsheets on my website are now the 2009 default spread. So when you do the synthetic rating for your company, you might get a rating that looks similar to the rating for that company a year ago, but the spreads are going to be wider, which means the cost of debt is going to get pushed up because of those spreads. Okay? So even if you don't update the rest of the table, the default spreads are worth updating. I have a very good website that I'll give you. I gave this to you in corporate finance, but I'll give it to you again. It's called bondsonline.com. Okay? Try it out. It used to be free, but it no longer is. They charge you $29 to get a snapshot. But that's all we need, right? We don't want to do it every day. So every 6 months I go and I pay my $29, I take my snapshot, and then I populate the rest of my table. Okay? But basically what they do is they give you updated default spreads by rating based on bonds traded at that point in time. So it's actually very timely. It reflects what's happening out there. So take a look at it because they have some, they both have industrial spreads, financial rating spreads. Basically you can pick and choose what you want to use out of there. Yes, Luke.
Ultimately, the drivers of default spread are some kind of supply and demand mechanism?
Ultimately, the drivers of default spreads is risk aversion. Right? It's always demand and supply. I mean, that's almost given that when you have a market, there's got to be demand and supply, it's got to clear. But what's driving this is people are more risk averse. Why they're more risk averse? We don't even need to answer that question, right? Because we all are more risk averse. Okay? So that risk aversion is going to show up both as a higher equity risk premium and a higher default spread. Okay? Maybe there are, and that's the question: is will the risk aversion subside? Will we return back to norms, or will we stay at this level? That's again a debate about the same debate we have with equity risk premiums. You're going to have with default spreads as well. Okay? Now let's deal with the question of subsidized debt. Embraer has debt on its books from the Brazilian government and related entities that's at about 6% rather than 9.29%. And they have different reasons for it. Infrastructure company, employs a lot of people, important to the economy, therefore we give it some. So here's my question, it's a very practical one. You're doing a cost of capital for Embraer. We computed a 9.29% cost of debt based on the synthetic rating and added to the risk-free rate. But the company has much cheaper debt. When you do the cost of capital for Embraer, should you use a 6% cost of debt because that's the rate at which the government lends to you? Should you use a 9.29% cost of debt because that's the rate at which they should be borrowing? Or will you kind of split the difference? Carry this to the logical extreme. Don't just think about what the cost of debt is. Think of what will happen to the cost of capital and the value that you attach to the company using each. If you use a 6% cost of debt, you're going to end up with a lower cost of capital and a higher value for the firm, right? Part of that value is a subsidy value from the government. That's fine. I mean, as long as you recognize. If you use a 9.29%, you're going to end up with a higher cost of capital and a lower value. Here's my concern with building in that 6% into your cost of capital. You build that into your cost of capital and you leave it untouched. What are you assuming? That the government will continue to subsidize your company in a sense in perpetuity. And that makes me a little nervous. Second, do governments do anything for just good? I mean, just to make you happy? I mean, if they give you a subsidy, do they expect something in return? There's always a catch here. So here's my response generically to subsidies. Whether it's a cost of debt subsidy, a pricing subsidy, is I will first value the company as if there were no subsidy, which means I use a 9.29%. Then I bring in the subsidy. It's actually very easy to value the subsidy here. The subsidy is you're borrowing at 6% rather than 9.29%, right? Take the subsidy and say, this is how much I'm being subsidized each year. Estimate the number of years for which you're going to get the subsidy, compute the present value. That will give you a dollar value of the subsidy here. Okay? You don't even have to do the entire valuation. Just focus on the bond. That's the only thing that's going to change. Ask yourself, instead of the 9.29% bond, if I had a 6% bond. So let's say the subsidy creates a value of 100 million for you. Then ask a final question. What am I giving up to get this subsidy? What does the government get from me in return for this 100 million? You know why that question is important? What if what you're giving to the government to get that subsidy is costing you 150 million? Okay. I mean, I'll give you an example. I had to value a sugar manufacturer in India, and in India, sugar is, there's a subsidy from the government that they get that gives them a 30% increase in prices or whatever it is. But in return for doing that, they're required to sell the sugar to some government stores at well below cost. So that's the kind of trade-off, is you get a subsidy. So basically, I value the sugar company with no subsidy first. Then I put in the subsidy and said, this is how much you're getting because of the subsidy. And then I costed up what it was costing them to kind of sell sugar at below cost to keep the subsidy. And I showed them that with the subsidy, they're actually losing $28 million a year. But it's only when you clean the subsidy, take it out of the process that you see it. Because the minute you embed into valuation, make it one composite valuation, it's all going to be in there. Management can't step back and ask, what are we gaining from that subsidy? It's a question a lot of banks are asking right now, right? Especially if you're not a bank that absolutely has to go to that TARP fund. I think there should be a debate going on. Should we actually draw on it? Because there is a cost here. And that cost could be substantial. And if you're a bank like Citibank or Bank of America, you might have no choice. But if you have a choice, if you're Wells Fargo, and you can say, look, I can live without the subsidy. I think somebody has to cost it out. Say, this is what we're getting from the subsidy. This is what it's costing us. Let's see if the net is positive or negative. Right? In fact, Deutsche Bank has decided that it doesn't want a subsidy. We've seen. I mean, I think that's a legitimate decision to reach, but to reach there, you've got to kind of cost and benefit out the subsidy. So now we have a cost of equity and a cost of Malik?
Yeah. So could you also argue that you would, if you were to use the subsidized cost of debt, that you wouldn't actually be tracking the intrinsic value of the company rather than?
No, it is part of the intrinsic value. The problem is that intrinsic value, some of it is coming from taxpayers. So if you started breaking down where does my intrinsic value come from, some comes from making better aircraft, some comes from tax benefits on debt, some comes because the government gave you a benefit. So I mean, it's still part of your intrinsic value. It's just that somebody's giving you, that component. Yes, Luis. I'm sorry. Two Luises.
Loans are in form of convertible preferred. Are you going to talk about preferred?
We're going to talk about that hybrids. Yeah.
This question: if you're doing a cash flow to equity,
Yeah.
will you consider looking forward your future cost of debt, or would you get each one of your term structures of your debt and use that for the?
You're saying would I use actual interest expenses or kind of based
Yes,
on?
because
Okay, that-
when the bonds finish,
Right.
you get then you use the new.
Remember the first weekly challenge? We talked about equity valuation and firm valuation going off in different directions. Here's another reason it happens. Because when you do free cash flow at equity, you subtract actual interest expenses, right? Which might be based on short-term debt. When we do cost of capital, we replace that with kind of a synthetic cost of debt. If you want your free cash flow at equity valuations and firm valuations to converge, you should be moving towards a synthetic interest expense over time. But here's the reason you have to be careful about just building actual interest expenses. What you're not building in is your equity actually gets riskier if people are using short-term debt to fund long-term projects. If you build in that effect appropriately into the cost of equity, there should be there's no free lunch here. How can your value as a steel company increase just because you replace long-term debt with short-term debt? And your valuation suggests otherwise, you're missing some part of this risk picture. So that's, I think, a concern. I agree with you. Most people who do equity valuation kind of don't do it, but it's one more reason why the two approaches can give you different answers, and the answers are very different. And the main reason is because of this debt issue. I'd be very queasy about that equity value being higher simply because, to me, it doesn't strike me as a real value enhancement, something you did that should actually increase your value as a company. Okay. Any other questions? Oh, so now we have a cost of equity and a cost of debt. We need weights, right? What's the religious belief in finance? That the weights should be market value weights. So I'm going to ask you a question. Now, how many of you are doing the CFA? Anybody here doing the CFA? Okay. CFA is this endurance test where they make you read 11,000 pages and they ask you what was on page 6,755. Right? It's actually very focused. It's a very good accreditation to get if you're interested in pure financial analysis. I've actually had a long involvement with the CFA because I give their keynote speech every year, but I've never even thought about getting a CFA. Okay? I wouldn't even want to do it because just the notion of reading 11,500 pages, which I don't want to read, just strikes me with terror. Right? But every year I beg them to let me write their exam that year. Because I've seen their exams, and you know what they do? It's closed book, closed note, 500 questions, do this, do that, just mechanic. I said, just like me, if they ever let me write the exam, don't worry, they never will. I would replace the entire exam, all 3 levels, with one question. That's it. If you answer this question this year, you got all 3 levels of the CFA. You ready? So I'm going to ask you the question. If you can answer this question, you get all 3 levels of the CFA, but it's unofficial. You can put Damodaran CFA or whatever you want to call it. Right? So here's the question. In finance valuation, especially, we're told to use market value weights to come up with cost of capital. Why? And I'm going to kind of structure your other. Is it because the market is usually right? Think through it, because if you answer this, I can come back and use this against you later in this process, right? If you tell me that the reason you use market value weights is because the market is usually right, see the hole you're digging for yourself? You put market value weights, you come up with the cost of capital, you use the cost of capital to do what? To value the company, then in the valuation you tell me the company is undervalued or overvalued relative to the market, and I say, no, you told me the market is usually right. You can't have your cake and eat it too, right? If you're in fact consistent, every one of your valuations, so be careful with the market is usually right. Is it because market values are easy to get? Are they actually? Market value of equity, if you're a publicly traded company, might be easy to get. Why am I saying might be easy to get? What about a publicly traded company might make market value of equity messy? Take Under Armour. Right? Under Armour is, I mean, for those of you who are, it's a company that's come out of nowhere. It's got two classes of shares. One is non-traded, held by Kevin Plank, the guy who founded it. So, but that's part of, part of the equity, but it doesn't trade. If you have two classes of shares and one doesn't trade, getting market value of equity could already become a little dicey. But let's take the market value of equity as the easier side. What about the market value of debt? If you have bank loans, you can already see that so it's not obvious in market values. After all, book value should be easier, right? It's right there in front of you in the balance sheet, book value of equity, book value of debt. So it can't be because market value is easier to get. Is it because book values of debt and equity are meaningless? This kind of feeds into this let's bash accountant thing, which I like to join in anyway. So, but what's the danger of saying this? Book values of debt and equity are meaningless. Because later in this process, might you have to use book value of debt and equity to compute something as return on capital? So if you tell me it's meaningless, I'm going to come back and say, but I thought you told me it was meaningless. How come you're using it for your return on equity and return on capital computations? So actually, I haven't given away the game. None of the above is actually the right answer to these questions. So my question to you to get all three levels of the CFA is, what is the right answer? Why do we use market value weights for debt and equity in computing cost of capital? Here's your chance. You know that I'm going to give you the answer, act like you gave me the answer, I'll give you the CFA anyway. Okay? Every discounted cash flow valuation is an exercise in acquisition valuation. You're acting like you're acquiring the entire company on the sly. Let me explain why I put the on the sly on there. We're acting, so you're an acquirer, you're going to go buy all of the equity in the company and all of the debt in the company at today's market price. You actually tried to acquire a company. What would happen to the prices? The minute you announce, I'm acquiring the company, the price is going to go up. That's why I put the on the sly in there. Every discounted cash flow valuation, you're essentially acting like you're acquiring all of the equity in the company and all of the debt in the company today at today's market price. That's why we use market value weights. See why this helps you? Because if later on you come up with a different value for equity for this company and somebody asks you, how come you didn't use that number to come up with the weights? You're saying, look, what I think the value of the equity is not what I pay for it. So if everybody thinks it's worth $100 and that's what it's trading for, whether I think it's worth 20 or 200, it's kind of irrelevant. It allows you to explain what I think is one of the most classic inconsistencies in discounted cash flow valuation, which is the weights you use for debt and equity in your cost of capital are market value numbers. But at the end of the valuation, you turn around and tell me those numbers were wrong, right? I mean, think about it. You put in a $50 stock price to come up with the cost of capital. Then at the end of the process, you say, hey, you know what? I think the stock is really worth 85. But you can pull that off if you divide into two steps. The first step when you do cost of capital, you're looking at what it costs you as an acquirer to buy the company. And you don't pay your estimated value, you pay market price. In the last step in the process, you're telling me what you think this stock is worth based on your assessments of the cash flows and the discount rates. So that's why we use market value weights. And that's why you have to be careful about using target debt ratios. And those of you who've been involved in valuation, often you see these games being played. Let's try target debt ratios. Let's try this debt ratio. If you're a passive investor, you don't get to set debt ratios, right? You have to take the company as a given. If you're an acquirer, then maybe you can use target debt ratios, but you better make sure to carry that through in your actual valuation to use those debt ratios when you acquire the company. Okay. Yep.
But when you are acquiring a company, you have to assume that there's a premium for.
Let's not even go there. Then you're not in a discounted cash flow. That's why I said this is almost a hypothetical exercise, because if you actually acquired a company, there might be all kinds of side issues you have to deal with that we're not dealing with here. Okay? So it's almost like an acquisition valuation without any of the additional stuff that usually makes it messy. Okay? So let's do the cost of capital for Embraer. Right? Cost of equity. So basically, this is the page we've been leading up to over the last 70 slides. Risk-free rate, beta, risk. Let's pull them all together. I'm going to first do a cost of capital for Embraer in US dollars. Okay, so the risk-free rate I'm using is the T-bond rate then. That's the beta for aerospace companies. Remember the global aerospace beta that we use, 1.07. 4% used to be the mature market premium in the old days when I was less cynical about risk premiums and I used the average implied premium over the last 45 years. So that's a 4%. 0.27, remember where that came from? That's a lambda that we got by regressing Embraer returns against the C-bond. 7.89% was a country risk premium for Brazil in 2004. So you pull all those, on 2003, pull those numbers together, the cost of equity for Embraer based on that beta and that lambda is 10.7%. The market value of equity at the time that I did this analysis was about 11.04 billion reais. Cost of debt, risk-free rate, country default spread, the 4% for Brazil, 1% for Embraer gives me 9.29%. Market value of debt, 2.083 billion. Let me step back there. Embraer actually had relatively little publicly traded debt. Most of its debt was bank debt. No. The way I computed the market value of debt was I essentially took what was in their financial statements and tried to estimate the market value. Here are the numbers I look for. I look for the interest expense, 222 million, that came off the income statement. I looked at the book value of the debt that came off the balance sheet, and then I looked for the average maturity of the debt, which is in the footnotes of the balance sheet. What I'm trying to do is apply what I know from pricing a bond to looking at the entire debt structure. Think of this as a gigantic corporate bond with a coupon rate payment of 222 million, a face value of 1.95 billion, maturity of 4 years, and I'm using the 9.29%, which I think is the right interest rate today, to compute the present value of those payments. What I get as a present value, 2.083 billion, is what I've used as my estimated market value. This is my way around the practice of using book value of debt as market value, because I think that can get you into real trouble, especially with distressed companies. Most of the time you can get away with it. This keeps me honest because it forces me to think about whether that book value is a reasonable estimate of the market value. I'm replacing the book value with an estimated market value. In this case, did it make a big difference? Not really. The 1953, 2083 are fairly close to each other. The reason Embraer's market value of debt is higher than the book value of debt reflects the fact that they have actually higher interest expenses on their debt than I've estimated with their dollar cost of debt. Right? Luis?
If you haven't included the lambda, your cost of equity will be lower than the cost of debt. Is that something that happens to you normally?
Did everybody get the question? What if you're doing the cost of capital computation and your cost of equity is less than the pre-tax cost of debt? It's actually a troubling scene, right? Why? What's the problem with trying to defend that, with cost of equity being less than the cost of debt? Who gets first claim on the cash flows? Debt holders, right? They're charging 10%. I'm behind that guy in line. Logically, I should be charging 10% plus. This is driving a lot of analysts crazy right now. You know why, right? What do we say happened to default spreads? They actually widened out more than equity risk premiums. There are, I think, at least a quarter of highly indebted companies now where the cost of debt, the pre-tax cost of debt, forget about the after-tax, the pre-tax cost of debt is higher than the cost of equity. Okay? Does it make me uncomfortable? Yes. Can I live with it? Sure. I mean, it's not the end of the world. I can go keep on. I don't think it's a steady state. In other words, it's not compatible with the going concern that we've kind of assumed in discounted cash flow valuation. So over the course of my valuation, I've got to bring these numbers back into sync. In other words, even though when I start the process, the cost of equity might be lower than the cost of debt, as I go to year 2, year 3, year 4, I'm going to start to bring the debt ratio down, bring the cost of debt down. And by the time I get to a point where I'm locking the company into a going concern, it's going to look more like a regular company. Okay? But it can happen. I mean, especially at strange times in history, like right now, you can get the cost of debt kind of balloon out because you have a credit crisis.
As of today, the problem is with the cost of debt, not the cost of equity.
I think it's a relative cost. Basically, both premiums have gone up, but because the cost of debt has gone up so much more than the risk premium has, you're seeing it more on the debt side. So I don't want to blame just the debt side, but the debt side, I think, reflects the fact that if you have a credit crisis, people are not lending money. The spreads are going to start reflecting that. Okay? So my dollar cost of capital here, based on the 10.7% cost of equity and the 9.29% pre-tax cost of debt. And incidentally, when you do after-tax cost of debt, always use the marginal tax rate. Right? Remember the rationale we used in corporate finance? Why when you do after-tax cost of debt should you always stick with the marginal tax rate and not try an effective tax rate or an average tax rate? How does a tax benefit on debt work? If you have interest expenses, they reduce your taxable income, right? So let's play along. Let's suppose you have $1 million in taxable income and you have $100,000 in interest expenses. What do you report as taxable income? You take the million, you knock off the 100,000, you report $900,000 in taxable income. Think of where you save taxes, between the 900,000 and the million, right? You didn't save it on the first 100,000, the middle 100,000, it's always the last 100,000. So when you do cost of debt, and we'll come back and re-examine this principle when you do cash flows, because there the principle might be different, but when you do cost of debt, the after-tax cost of debt, the tax rate you should be using should be the marginal tax rate. You will usually not find this in that company's annual report at 10K. It has nothing to do with the company. It comes from the tax code. Okay? In the US, for instance, the marginal tax rate for a company is going to be 35% plus. 35% is the federal corporate tax rate. You've got state and local taxes. Typically for US companies, the marginal tax rate is 38, 39, 40%. Okay? If you have a non-US company, of course, you have to check out the tax code there. There is actually on my website, there is a listing of marginal tax rates by country. I think there are like 93 countries on it. I would claim that I looked these all up, but I'd be lying. I stole them from KPMG. KPMG actually every year does a service for the rest of the world where they report tax rates by country. So I took the last numbers and updated them. So if you're doing a company, don't get caught up in the effective tax rate for this part of the computation. Look up the marginal tax rate and then kind of use that in your cost of debt. So I'm using a 34% marginal tax rate. That's a marginal tax rate in Brazil. Weights are 84% and 16% based on those values. Cost of capital in US dollar terms, and I want to emphasize that because it's going to be currency specific. In US dollar terms, the cost of capital for Embraer is 9.97%. Any questions on there? So lots of moving pieces in a cost of capital puzzle, right? The risk-free rate, risk premiums, lambdas, betas, default spreads. The key is to do it one step at a time. Don't jump steps. Don't try to get to the answer quickly because that's how we make mistakes. Right? So let's suppose I have a 9.97% cost of capital. So this took me to the 5th week of the semester. I have the cost of capital, and then I change my mind and decide to do this entire valuation in Brazilian reais. Can happen, right? Could happen to you. You could start off saying, I'm going to do everything in dollars, and then 4 weeks in, you could say, well, I think it'd be better to do everything in pesos. Sounds like a lot of work down the drain, right? Here's a quick and easy way to go from a dollar discount rate to any other currency. Okay? One is to go the long way. Go back and replace the risk-free rate, use a nominal real risk-free rate and build up. But there is actually going to be a problem when you do this. We'll come back and talk about it. But I'll go the easy way first, and then we'll talk about why the answers are going to be different. 9.97% is my dollar cost of capital, right? The only reason, and we talked about it in the context of risk-free rates, the only reason that nominal risk-free rates should vary across currencies is differences in inflation. So let's suppose I gave you two numbers. I told you that the expected inflation rate in US dollars is 2%. And the expected inflation rate in reais is 8%. Right? So there's a 6% higher inflation rate. Quick and dirty way to adjust the cost of capital is take the 9.97 and add 6%. Okay? But there is a compounding effect that you're missing there. So the full way to correct your US dollar cost of capital is take 1 plus the US dollar cost of capital, 1.0997, and scale it up to reflect the fact that you have an 8% inflation in reais and a 2% inflation rate in dollars. That gives me a dollar cost of capital. I'm sorry, a real cost of capital of 16.44%. It's a very effective technique to move from one currency to another. You want to go from dollars to pesos, dollars to reais, dollars to rubles. You still need two numbers, expected inflation of the two currencies, but with those numbers you should be able to convert any currency discount rate into a different currency. Actually, I got a much higher cost of capital when I used that risk-free rate plus or much different. It was actually a lower cost of capital, but a very different cost of capital. I actually think I got like 15 point something percent when I used the real risk-free rate approach. What's the difference between the two approaches? What am I implicitly assuming in the second approach that gives me a higher cost of capital than in the first approach? I'll give you a clue. It's got something to do with the risk premiums and default spreads and what I'm assuming will happen to them as I go from one risk-free rate to another. In the first approach, I go from a 4.29% risk-free rate to a 12% risk-free rate. What am I assuming about default spreads and risk premiums? They stay fixed. In the second approach, I go from a 4% risk-free rate to a 12% risk-free rate. my risk premiums get scaled up as my risk-free rate goes up. So if I have a much higher risk-free rate, I'm saying instead of settling for a 1% default spread, I'm going to charge a 2% default spread. Now I'll let you decide which one you think is more reasonable. Staying with fixed numbers that you got by looking at often dollar securities, right? Default spreads, risk premiums for computer, and taking those fixed numbers and attaching them to much higher risk-free rates. Or the second approach, we're going to scale up those numbers to reflect the magnitude of the risk-free rate. I mean, I think that's really why the numbers are different. And to be truly consistent, I would rather go with the second approach because everything inside the valuation then will kind of keep up with the switch in currencies. So use market value weights, use marginal tax rates for the cost of debt, and the weights are going to be, the weights can change over time, but you're going to start with the market value weights. Final piece, and this is a question that Luis asked about hybrids. Hybrids are a pain in the neck. They're a pain in the neck because they're part debt and part equity. Classic hybrid, convertible debt. What's the essence of a hybrid? What part of the convertible debt is equity? In convertible debt, what do you get? You get a straight bond and you get the option to convert it into equity, right? The conversion option is equity, the straight debt is debt. If you treat hybrids as a separate way of financing, you're asking for trouble. And you see what the trouble is going to be? Convertible debt is going to look cheap, right? The nature of convertible debt is the coupon rate on convertible debt is going to be much lower than the coupon rate on straight debt because people are getting the equity option. So when people add a convertible debt component to the cost of capital, often it'll look like, hey, that's much cheaper than traditional debt, let's replace it. So here's what I'm going to do to stay internally consistent. You come to me with a convertible bond, I'm going to strip it into a debt portion and an equity portion. How would I do that? If I value one piece, the other piece will fall out, right? Which is the easier piece to value, the debt portion or the equity portion? Unless you're some kind of an option fanatic and you like using the Black-Scholes, it's easier to value the debt portion than the equity portion, right? So here's what I'm going to do with a convertible bond, and I'll come back to the preferred stock. I'm going to act like it's a straight bond. Hey, let me take an example. Let's assume you have $125 million of convertible debt, face value, with a stated interest rate of 4%. The interest rate is low because it's a convertible bond. Okay? Let's assume the market value of the bond is $140 million and it is 10 years to maturity. Let's also assume that if this company issued straight debt, it would have to pay 8% on that debt based on its rating. So here's what I'm going to do. I'm going to act as if this debt was just straight debt with a 4% coupon rate and ask what price would I be willing to pay for this debt if my correct market interest rate should be 8%. So basically I took the coupons, 4% of 125 million, discounted back at 8%, took the 125 million, which is the face value, also discounted back at 8%. What I get as an estimated value, 91.45 million, is my debt portion of the convertible debt. I know the total market value is 140 million. You take the difference, the 48.55 million will now become equity. So when I do my cost of capital, here's what's going to happen to the convertible debt. 48.55 million is going to go into the market value of equity. I'm going to add that on to the share price times number of shares. 91 million is going to go in with the debt. There's no more hybrid to worry about. I can move on. So convertible debt, actually the best thing to do is split it up. Yeah.
Use the interest coverage synthetic rating
Right.
for the company.
You might understate the rating, right? It could happen. I mean, there's no easy fix for it. If you have so much convertible debt that you're worried that you're understating it, the best thing to do is replace the coupon rate on the debt with the correct market interest rate. See what your implicit interest expenses would be. Right? But in effect, the higher interest coverage ratio you're getting is in fact the truth, right? Because you have a lot of convertible debt on your books, but if most of it is equity, you really have a lot less debt on your books than it looks like from the outside, right? So in a sense, a convertible interest expense is telling the truth about how indebted you truly are, that you really don't. I mean, there are a lot of technology companies where they have convertible debt, but it's almost all conversion option. There's really no debt to speak of, but on the books it'll show up as a big debt number. So maybe it's not that bad to give them a higher rating and reflect that in the interest coverage ratio. If they ever converted that debt into straight debt, they're going to have a problem, but presumably they're not going to do that until they get the income to cover the interest expenses. So convertible debt is a fairly straightforward security to deal with. You know what really gives me headaches is preferred stock. I have debt and equity buckets, right? I come to you with preferred stock, at least in the US, and we'll talk about this outside the US later. In the US, how does preferred stock work? You issue preferred stock, you have to, what's true about the dividend? It's a fixed dividend. It's like a coupon. So it's starting to look like that, right? So you get ready to put the preferred stock into the debt bucket. But what's the problem with doing that? Why can't you put preferred stock into the debt bucket? It's not tax deductible. So if I put in the debt bucket, I'm going to give it a tax benefit it doesn't have. So I get ready to say, okay, I'll put it in the equity bucket. But it's really not equity either. Because it's a fixed dividend, there's no price appreciation on it. People don't buy preferred stock for the same reasons they buy common stock. So this is my one exception to the rule that you want two items in your cost of capital. If you have a lot of preferred stock, I'm going to open up the third component. So you'll have debt, equity, and preferred stock, all in market value terms. So cost of debt, cost of equity. What's the cost of preferred stock? It's just the preferred dividend yield, right? Because it's like a perpetual bond. You have the dividend, you have the price. It's a preferred dividend yield. Put that in as a cost of preferred stock. Don't put a tax advantage on it because you're not going to get it. So it's going to fall somewhere, if you've done this right, somewhere between your pre-tax cost and your cost of equity. But it's a one case where I will have a third component. Luckily, most US companies don't have a lot of preferred stock. The kinds of companies that do tend to be financial service companies. They're doing it for game playing, which just makes their capital ratios look much better. But if it's a big issue, treat it as a separate item, bring it into cost. Make sure the weights add up to 1 still. That rule still applies, but attach the preferred dividend yield. Yes?
For the convertible debt, if the debt is out of the money or it's
Then it'll already take care of itself, right? Because the question is, what if the conversion option is at a price that's way above today's stock price? How will that show up here? What's going to happen to the market value of the convertible bond? As the option value kind of dissipates, the market value of the convertible bond will move towards 91.45. So it'll take care of itself. That's the nice thing about this, is it's self-correcting. Stock price shoots up, the equity option value will increase, the equity portion will go up, stock price drops. So it takes care of itself as you go through the process. Yeah.
The way we'll calculate the equity portion is a dividend discount model?
No, we don't need it because you have the market price of the bond and you've got the debt portion, the difference is equities. So I don't even, if you really want to do the equity portion, you can't do the dividend discount model. What do you have to do? If you want to value the conversion option from scratch, you've got to use an option pricing model. I'm trying to avoid that. But the case where I might not be able to avoid it is if I can't get the market value of if it's not a traded convertible debt, then I might have no choice. I have to value the debt portion, the equity portion separately and do what I just described. Yes, Kevin?
Even now, frozen some of the convertible bond markets are these days, can you really avoid it?
Can I avoid what?
Because we're going to a method where you said that we're going to ditch historical ERPs.
Yeah.
So convertible markets they've been very, very thin.
But that's going to take care of itself, right? The price of the convertible bond would drop towards the straight bond portion. So the market price of the bond should already take care of it. So when I break it up, it's going to become almost all debt.
But getting the market value of it is
Okay, that's a different question. If you can't get a market value, you have no choice but to go with an option pricing model. So in that case, you say, look, I don't trust the market prices. The trading is too thin. Then you have to value both pieces. Right? So value the straight debt the way I described it, value the conversion option using option pricing models, and it's really not a difficult option to value. So you basically will add up the two then, and that will be the total value of the convertible bond. Right? But you're still following the same framework. Right? So let's review the cost of capital. Question? Somebody had a question like that? No? Cost of equity based on a bottom-up beta. Cost of debt is the rate at which you can borrow money long-term today, based on either an actual rating or a synthetic rating. Marginal tax rate to capture the tax benefits of debt. Weights are market value weights. Okay. So let's talk about cash flows. Basically, there are 3 steps to estimating cash flows. First, and forget about cash flows in the future. Let's get cash flows last year nailed down before we get too ambitious, right? First step, you need to tell me what you made last year. That should be the simplest of all questions, right? That's why we pay accountants millions of dollars to prepare income statements. But I'm going to start there because it's not clear to me that I can take the number right off an income statement and say I'm done. So we're going to start with current earnings. Those earnings can either be pre-debt earnings if I'm looking at cash flows of firm, operating income, or post-debt earnings, net income if I'm looking at equity cash flows. Second step in the process, I have to estimate how much of that money I made last year was reinvested back in the firm. Why do they need to reinvest? If I want them to grow, some of that money has to go back into the firm. So we've got to figure out how to measure reinvestment. So we have to measure earnings, measure reinvestment. And then there's a final step that applies only if you're doing equity cash flows, which is you've got to figure out how much debt you're going to repay, how much cash goes to debt, and how much cash comes in from debt. That's a net cash flow from debt that's going to affect your cash flow to equity. Earnings, reinvestment, cash flows to debt. In fact, if you look at the three definitions for cash flows, one, you cop out. The cop-out definition is you trust managers and say whatever they paid in dividends is what they could have afforded to pay out. That's in fact the kind of short and dirty measure of cash flow to equity is let's look at the dividends, maybe add stock buybacks, we're done. The more generic definition of cash flow to equity is to look at what cash is left over after reinvestment and after debt cash flows. So basically you start with net income because you're looking at equity cash flows, you subtract out the reinvestment, and we're going to look at two items in the reinvestment. How much went into long-term assets, which we measure as the difference between capital expenditures and depreciation. How much went into short-term assets, which we measure as the change in working capital. And then we subtract out cash flows associated with that. So free cash flow to equity. So dividends, you trust managers. Free cash flow to equity, you actually estimate what they could have paid out. So actual dividends, potential dividends, and cash flow to the firm. Where instead of starting with net income, you start with operating income. You still subtract out the same reinvestment items, but you stop. You don't subtract out debt cash flows because cash flows to the firm. Debt is viewed as one of the suppliers of capital. They're not outsiders anymore. They're viewed as part of the game. So basically in all three approaches though, you start with earnings and work down. So much as I like to, as I said, dump on accountants, we are incredibly dependent on that earnings number being right. So I want to start off with that question of earnings numbers. How do we get that operating income and net income to get started? So I'm not even talking about future growth. Let's get the earnings from last year nailed down. How do we come up with those numbers? Incidentally, before I do that though, if you look at the free cash flow to the firm definition, there's an embedded puzzle there that I'd like you to tell me what the answer to is. To get the free cash flow to the firm, I start with the operating income. I act like I pay taxes on that operating income. So it's almost a hypothetical tax. Then I subtract out my reinvestment. It's almost like I'm ignoring the cash flow, the tax benefits created by interest expenses. When I do cash flow to the firm, where are the tax benefits that show up because of interest expenses? Where is it going to show up? Yeah.
When you add back depreciation.
No, depreciation won't do it, right? Depreciation
no,
is...
The depreciation was from the net income, you subtract it on the costs.
No, that's for depreciation. I'm talking about interest expenses. I'm acting like I have no interest expenses.
The net depreciation is full with the interest expense.
No. Why would interest expense even play in depreciation, right? Depreciation just comes from what you invest in the asset and what you wrote off. So,
but then you subtract that from the income?
No, I haven't. Basically, I'm starting with operating income, earnings before interest and taxes. So whatever I subtract as depreciation, I add back. My question is, where did the interest expenses go? Yeah.
Capital is after tax benefits.
In fact, the right answer to the question is it's not supposed to be in the cash flows. The interest expenses, tax benefits should not be part of your cash flows because these cash flows get discounted back at the cost of capital, and the cost of capital already reflects the tax benefit of debt. How? Where in the cost of capital did I bring that in? When I multiply the pre-tax cost of debt by 1 minus the tax rate. You know how many discounted cash flow valuations I see where interest expenses get double counted? The way they get double counted is people use actual taxes paid to subtract out from operating income, which means your cash flow is going to get pushed up because you got a tax benefit from debt. Then you discount that higher cash flow now at a lower cost of capital, counting the same tax benefits. You've just counted the tax benefit twice. So don't go looking for tax benefits from interest expense in your cash flows. It's in your discount rate. We'll come back and talk about, is there some other way I could do it, or I could bring it in? Maybe there's a way to do it, but the way we compute cost of capital right now, our discount rates already reflect the tax benefit from debt. That's why this cash flow is often called an unlevered cash flow, because this is the cash flow you'd have had if you had no debt, and then you let the cost of capital carry the weight of whatever tax benefits you get from debt. Okay? So let's take that first step. Let's talk about earnings. Okay? Basically, there are three things I want to kind of draw your attention to around earnings, and a couple of other side issues I want to examine. Okay? So the question we're asking here is, when we measure earnings, what are some of the things we have to watch out for? First, you're valuing your company as of right now. Right? Remind yourself of that. You're not valuing it as of January 1st, 2008. I don't care when the last financial statements came out. You're valuing a company as of right now because that's the only time that matters. Because you can either buy the stock or sell the stock today. Who cares whether the stock was undervalued or overvalued a year ago? So you want numbers that are updated, right? But here we run into a problem. All market numbers get updated all the time. So if you ask you what the market price was, you can go look it up right now. If I ask you what the operating income was, what's the problem? Accountants don't update financial statements every day, right? In fact, if you trusted annual reports, the last financial statement you're going to have for your company is going to be from 2007 for many of your companies, which is ancient given what's happened in the last year. So if you're going to do a valuation of a company today, you want the most updated numbers you can for earnings. The US, at least, the fallback position is, we can at least get trailing 12-month numbers. Even though the annual report might not come out till March or April, I can take the last 4 quarters. Even that might not be updated enough, right? Because that trailing 12-month number for most US companies with a fiscal year end, that's in December, is going to go through September 30th of 2008. And we all know what happened in October, November, and December, and we know that last quarter is where the pain is really coming. But you can go with trailing 12-month numbers. In fact, for this year, I would take the first 3 quarters from 2008. I would use the estimated loss from the last quarter, and use that as my updated number, even though it might not be even though you might have some uncertainty about that last quarter. It's better to go with updated numbers than with non-updated numbers. With non-US companies, things get a lot messier. In many countries, you have only 6-month updates, not even every quarter. In some countries, you don't even have full updates. You have partial information, revenues, maybe operating income, maybe net income, but not the full financial statements. Those countries, you're really at sea valuing companies because so much of the data is old data. So the first rule in valuation is use updated numbers. And we'll talk a little bit about how to quickly compute updated trailing 12-month numbers, but you want the updated numbers. Second, that number that you use as your starting earnings, the base number, is the number that you build off, right? So if you start with a bad number, bad things are going to happen to your valuation. So if you have a company whose earnings go up and down, cyclical companies, commodity companies, and you take the most recent year's numbers, and depending on where you're in the cycle, get a low number or a high number, you run the risk of overvaluing your company or undervaluing your company. Right? So you take ExxonMobil today. You take 2008 earnings, which was what, 42 billion, some huge number in spite of the slight drop off they had in the last quarter. It's a huge number. You take that as your base year, I guarantee you ExxonMobil is going to look like a bargain because you took a peak year number. You take any bank and use 2008 numbers, I'll save you the trouble of doing the valuation. Don't buy this bank because you're going to take a bad year and kind of make that your base year number. It's one of the toughest things to do in valuation is normalize earnings, because there's no simple rule I can give you. Use 5 years average, 3-year average, because it really is almost company specific. So some of the valuations we're actually going to do, that's going to take the bulk of our time, is normalizing earnings so you can get the base year nailed down. Once you get the base year nailed down, everything else kind of takes care of itself. So we're going to normalize. And thirdly, I have to clean up after the accountants, because there are some inconsistencies in the way earnings are computed across companies that makes it difficult for me to compare those numbers. In particular, I'm going to focus on 2 items that I think screw up earnings. The first is the way accountants treat leases. They treat it as operating expenses when in fact they're financial expenses. I have to clean up for that. We did that in corporate finance as well, because it makes a big difference when you look at a retail firm whether you treat lease commitments as debt or you treat lease expenses as operating expenses. The second item I'm going to clean up for is the way in which accountants treat R&D. Okay? R&D basically is a technology company's CapEx, right? But the way it's treated right now is it's expensed when you make it. So I've got to clean up for that, because if I really want capital expenditures and cash flows for a technology company, I need to be clear about what's capital expenditure and what's not, and R&D to me seems like clearly capital expenditures. So that's kind of a summary of where I'm going. Let me take each of those items. Okay? Let's start with the updating issue. If you wanted to get trailing 12-month numbers, let's say you're doing a US company, give me the mechanics of getting trailing 12-month earnings. How would you do it? The long way is to do what? Download 4 quarterly statements, right? Add them up. There's a much easier way to do it. download two SEC filings, a 10K and a 10Q. That's all you need, one 10K and the most recent 10Q. The most recent 10Q, let's say it's a September 30th 10Q, will have the first 3 quarters of 2008, but it'll also give you the first 3 quarters of 2007. It'll give you the comparison. So here's what you need to do to get trailing 12-month numbers. Take the 10K numbers, subtract out the first 3 quarters of 2007, add the first 3 quarters of 2008, you're done. In fact, what I do actually is I set up a spreadsheet because it's kind of painful to do this on a one-by-one basis. I set up a spreadsheet. In the first column, I enter the 10K numbers, revenues, operating income, net income, capex, depreciation. Second column, I enter the first 3 quarters of 2007. The next column, I enter the first 3 quarters of 2008. Last column, to do the same thing. Subtract out 2007, add back 2008, you're done. If you really want to do it the long way, I'm not going to stop you. You're going to get to the same answer, so you can add up 4 quarters, but it's much easier to take a 10K and a 10Q and build up to trailing 12-month numbers. As I said, it's particularly critical that we do it in years like this when so much is changing. It's also even more critical if you're valuing a growth company or a young company to do this, because numbers change so much at these companies over a 3-month or a 6-month period that if you sit there with 2007 numbers, you're asking for trouble. I mean, you value Google with 2007 numbers, that's like ancient history. So update numbers, more critical that you do it now, and more critical that you do it if you have growth companies, because that's where you're going to see the biggest differences. Any questions on updating numbers? If you have a European company, do your best. Okay, I mean, do your best in the sense you're going to see patchwork of data, some updated, some not updated. Oh, one more thing. Even US companies don't update everything, right? What are the things you will not find in a 10Q? You might not find options. For instance, there's a table with options, management options. You might not find that in a 10Q. Some 10Qs don't have lease commitments. Only the 10Ks do. Don't get caught up in this consistency trap. You know what the consistency trap is? Which is everything has to come from the same financial statement, because I guarantee you then you're going to end up with the 2007 numbers. Use a very simple rule. You want the most updated data for every single data item you look at, which basically means it could be September 30th for some data items, December 30th for others, and for market price it could be today's numbers. It sounds inconsistent, but you're actually being consistent. You're using the most updated data. It just happens to be updated at different points in time. Okay? So use the most updated data when you do your valuations. Second, let's talk a little bit about correcting basically, if you think about a classic income statement, you're supposed to take revenues. You're going to subtract operating expenses to come up with operating income. You subtract out financial expenses to come up with net income. So if an income statement is set up right, that's the way it's supposed to work. And capital expenses are off the income statement. They don't affect your income in the year that you make them, but in the years following you get depreciation and amortization. So here's my issue with lease commitments. To me, lease commitments are just a replacement for debt. So rather than borrowing money and buying a store, you've leased a store. So I should be treating lease commitments just like that, which means I should be taking them out of the operating expenses and treating them as financial expenses. I already told you, R&D I think is capex. It should not be treated as operating expense. It should really be treated as capex. So what I'd like to do at least is set up a framework for first doing leases, and then we'll talk about R&D. We're going to convert leases from operating to financial expenses. And with both these conversions, I have to warn you, there are going to be ripple effects. It's not just the conversion, it's going to change your income, it's going to change your capital. You basically are going to redo the financial statements for a company when you make these conversions. So let's start with leases. You look at any retail firm, you look at any restaurant, you're going to see big lease commitments. In fact, to give you a sense of how much lease commitments matter across different businesses, across the entire US market, about 12% of all operating expenses are operating lease expenses. That's a pretty big number. But in sectors like apparel and furniture and restaurants, you can see it's an even bigger number. For a furniture store, for instance, half of what you see as operating expense is really lease expense. So here's what we need to do. We need to take those lease expenses and treat them for what they are, which are really financial expenses, expenses associated with the use of debt. To do that, here's what you need as additional information. When companies lease stores, it's not the lease expense last year that worries me. It's a commitment they've entered into to make those lease expenses. You signed a contract, right? You're the Gap, you open a store, you've signed a contract to make those expenses for the next 10 years. So what I'd really like to know is not just what you spent last year on leases, but what the commitments are that you've entered into to make payments in the future. US companies for the last 20 years have been required to show this as a footnote. So you take any US company, you pull up the 10K, you look for lease commitments or rental commitments, you'll see a table that lists out commitments for next year, 2 years out, 3 years out, 4 years out, 5 years out, and a big lump sum beyond the 5th year. If we decide that lease commitments are essentially the equivalent of debt commitments, then converting leases into debt becomes trivial, right? How do we compute the market value of a bond? What did we do? We took coupon payments and face value, and we discounted them back at the pre-tax cost of debt for the company. That's how we did Embraer, right? If we treat lease commitments as the equivalent of debt, here's all you need to do to convert lease commitments to debt. Take those commitments and discount each one back to today using the pre-tax cost of debt as the discount rate. Why the pre-tax? Why not the after-tax? Because the lease expense is a pre-tax expense. It's just a consistency issue. The commitments they've given you are expenses before taxes, so use a pre-tax cost of debt. What you get as a present value will be the debt value of operating leases. Here's what I meant about ripple effects. If you decide to do this, and you now put a new item in your balance sheet, right? Debt. Let's call it operating lease debt, $13 billion. So now on the liability side, you've got a $13 billion debt. On the asset side, you need a $13 billion asset. Otherwise, the balance sheet will not balance, right? So you've got to bring in a counter asset. Let's call it a leased asset. You see the Pandora's box we just opened? Once something shows up on the balance sheet as an asset, what do we have to do in subsequent periods? We have to depreciate it. So I wish I hadn't opened this box, but you have no choice. So when you convert leases to debt, you create those side effects. You're going to get depreciation, which also then means that what you see stated as operating income for this company is not the right operating income, right? Because that operating income was after lease expenses. So here's what you need to do. You need to add back the operating lease expense because it's no longer an operating expense, so your operating income is going to go up. But you now have to subtract out the depreciation you'd have had on the leased asset to come to the true operating income. I actually prefer a shortcut because it tends to give me pretty much the same answer. I actually take the operating income as stated, and I add to that the interest expense I'd have had if this had actually been debt. Think of it as an imputed interest expense. Because if it's earnings before interest and taxes, and this were really debt, the earnings should have been higher by that interest expense. It's a quick and dirty way of adjusting operating income. But my point is, if you decide to convert leases to debt, you have to go the whole way. You've got to adjust the operating income, you've got to create the leased asset, you've got to compute the depreciation, which means when you later do things like EBITDA multiples, enterprise value, you have to stay consistent with this notion of leases being debt. You can't just bring in the lease debt and leave everything else the way it used to be. Okay? I've seen this with EV to EBITDA multiples that analysts use for retail firms. They will in the numerator add 8 times the lease payment. Where did that 8 come from? We've been around retailers. That's the rule of thumb they use. They'll take the lease expense from last year and multiply it by 8 and say that's a debt equivalent of leases. 8 times actually came from the late 60s. When you had 12-year leases and 7% interest rates, some guy must have worked out the present value factor and come up with 8. And ever since it's stuck as a rule of thumb. Okay? Now we have financial calculators that can do this for us. I don't know why we need the rule of thumb, but that's where the 8 times lease comes in as a. But often they will treat that as debt, but leave EBITDA the way it used to be. You can't do that. If you convert leases to debt, the operating income, the EBITDA have to be adjusted to reflect those changes. Okay? So last page, and then we'll finish for the day. Yes?
With the approximation,
Yeah.
that you are not ignoring it?
You're not. Actually, you're assuming that the total expense that you have on a lease is part interest, part principal, and you're assuming that the principal portion is really the depreciation part. I mean, built in here are some implicit assumptions, but you're saying the total lease expense each year can be broken into the interest and principal part. The principal part covers the depreciation. The interest expense is what I need to add back. Okay? Last page. Okay? So I took the gap. Company with big leases. Those are my lease commitments for the next 5 years. Lease commitment of $1,976 million beyond the, or 975 million after the 5th year. So that's a lump sum. I spread that lump sum beyond the 5th year into 2 years. Why 2 years? Because I looked at the average payment over the first 5 years and it looked like a 2-year payment. In fact, the spreadsheet that I have for doing this does exactly that. It takes the average lease over the first 5 years, looks at your lump sum and tries to spread it out. I discounted those lease commitments back at 6%, which is my pre-tax cost of debt. What I get is a present value. 4.4 billion is the debt value of leases. Right? When we start on Monday, we're going to start with that. What I'm going to do is actually look at the ripple effect that creates for cost of capital, return on capital, cash flows, all the things we care about in valuation, why they're affected by this conversion.